Mark Okada of Highland Capital, co-founder and CIO, still with us. Mark, this story of reflation used to be good for credit. That's what we associated it with historically. Has that changed? Because Mike Swell thinks it has.
Well, he mentioned the term duration, and that's interest rate risk, right? And for the IG markets that he's referencing, or the U.S. credit market, yeah, it is fairly cheap compared to a lot of things you can buy globally, but it is very interest rate sensitive. So if you got rates moving up, that's going to hurt you in those portfolios. However, when you turn to the world that we live in, which is a lot of high yield and a lot of floating rate, there's still a lot of opportunity. Now, I tell you, it's time to be rotating up in quality within this market. I think our global outlook is not incredibly positive per se, but there still are a lot of things to do. So this rotational aspect of up in quality within credit, out of fixed rate into floating rate, those sorts of things make a lot of sense to us now, and there's a lot of attractive opportunities.
So when you hear de-risk, go to cash, you push back aggressively?
I do, because it's already happened. I mean, if you look at any sort of sentiment surveys, right, we have this unbelievable amount of uncertainty across investors, and when investors get uncertain, they sit on cash, and cash levels across the investor base has never been higher. So and trading is about what is, and investing is what will be. So we think about what happens when the election's over and that uncertainty comes out of the market and that cash needs to get spent. Right? That's what I'm focused on today. I want to put our investor capital in places where it's going. And higher quality credit should be a very big beneficiary of that when that happens.
And you also mentioned floating fixed rate. So take a look at the Bloomberg here, and this kind of shows your point. This is 3-month LIBOR. It's now at what? Almost 1%. We're 0.8 of 1%. That is a huge move. That's all due to some rules that are coming into effect on Friday. Does this move and your love for the fixed floating rate decline after Friday?
No, I think it's a permanent change in the way that market funds itself, the money markets, going from fixed to floating NAVs. Capital has shifted because of that, and that's what you're seeing in the LIBOR move. And so it could come off a little bit. It has moved a lot, to your point, Alex. But if you look at this move, and we have a lot of floating rate bank debt, we have, I have a big ETF that's doing very well in that space. It's moving up, and it's benefiting from this move, right? We're seeing that benefit already in our portfolio. So I think that continues to be a very nice source of yield. If you can make 5–6% in a floating rate environment, that's pretty good yield in here. And if it goes back down to 4.5 or 5, that's still not very bad, given our outlook for growth and inflation and those sorts of things.
Mark, you refer to the election and the uncertainty that's inserted into the marketplace from the election. In your estimation, is the market over-anticipating? Are they over-pricing in the uncertainty?
Well, that's a good point, and I do think they are. I think that there is the markets are and the economy are really bigger than some of these other trends. The election is one of them. Politics is one of them. So what will happen post the election, right? We will have a new president, and these two candidates are very different, but that will come off the table as far as uncertainty, right? And so what do you do next? Where do you put that capital to work? I think that's really the dynamic that we will see in 2017. And there are still parts of the U.S. economy that are fairly constructive. I mean, we're not growing at 3%, but are we growing at 2, 2.5, 2.25, something like that? Probably. And that might be a very good supportive backdrop for credit.
So on the one hand, you do have that floating fixed rate investment. Do you barbell that with, say, sovereigns or investment grade?
So the barbell that I have is really higher quality credit on one side, and then get ready for distress on the other. Because what is amazing about this reflation that we've talked about and the amount of credit that's been issued, if you look back at the last peak we had in the credit markets in 2007 to today, we have added trillions and trillions of dollars worth of debt into the system. So we've got a situation here now where we have over $8 trillion of outstanding debt in the high yield bond market, in the bank loan market, and the IG corporate market, and that is almost $3 trillion more than we had in 2007 when we peaked. So you can have a very small amount of increase in distress and have a big nominal amount of opportunity. So I think that's my barbell when I think about the opportunity going forward.
And Mark, you raise a really important point, because there's so much more debt on balance sheets right now. That debt's going to have to get turned over at some point. Because most of that debt is going to get turned over. What happens if there's a real difference in the interest rate when that happens? There could be a substantial shakeout on the part of a lot of companies.
Yes. Now, the calling rates is a tough thing in this kind of environment where we have so much government intervention. But I go back to the global growth dynamic and really how fast are we growing and how much inflationary pressure can you have when global growth is so slow and actually slowing right now. So the long-term interest rate outlook for us would be lower for longer. And in that environment, I think that's not the issue. For me, it's a little more basic. It's you have huge issuance years, and when you have those huge issuance years, a couple of years later, you have higher defaults. It's just the nature of below investment grade lending. And so you got to get ready for that. That's going to be a fantastic opportunity in the distressed market. And so that's kind of the barbell. And you're right. We could have interest rate problems. We could have interest coverage problems in different parts of the marketplace. But really, I think it's going to be just more a fundamental, good old-fashioned credit cycle that's coming. It's going to be big, though.
All right, Mark, good to see you. Mark Okada, co-founder and CIO of Highland Capital, sticking with us, because next we're looking at what he's doing with his equity portfolio now that we've got a 91-month-old bull market. Well, when you put it that way, it sounds pretty extreme. This is Bloomberg. This is Bloomberg Daybreak. I'm Alex Steele. Earnings season kicking off this week. We got Delta reporting this week as well. At the end of the week, we get the big banks. We get JP Morgan, Citigroup, and Wells Fargo. Mark Okada, Highland Capital co-founder and CIO, back with us. Mark, the theme in the market, the story, is the revisions that we're going to see for 2017. How bad are they going to be when earnings come out?
It's hard to tell, but it's going to be lower. All I see is headwinds when I look forward to earnings. We got the dollar strengthening in here, kind of coming up to that critical band of 100 in that range it's been. If it continues to go up based on the weakness of all these other currencies, I think that's a problem for earnings. We have wage pressure, right? Wage pressure is a pretty predominant thing across companies are seeing this now across the board. I think that's another detractor to earnings, and you're seeing it in operating margins. And then top line, really, I mean, where do you get growth in this environment? I think the punchline, though, when we think about earnings, ultimately, right, it's winners and losers. It's less about this big surprise in the overall number, and it's about picking winners and losers within the space. And if you can do that well, I think that will be an interesting opportunity around earnings.
Well, let's take a space. Let's take the financials. A big list of earnings coming up at the end of the week.
Yes.
We had a conversation around this table yesterday about the business models. You've got a Wells Fargo that used to be this kind of like gold flagship brand for
Absolutely.
American banking.
Yes.
And then you had the guys with the big markets businesses, and it was day and night. And now all of a sudden, a little bit of a pivot. The markets business, people have become a little bit more constructive on. Have you?
Well, I think the outlook for the big banks, right, depending on the election, again, if we keep status quo, they're becoming utilities, right? There's so much of the things that they want to do in that markets business that Elizabeth Warren and her crew just aren't going to let them do, unfortunately. And I do think it is unfortunate. It does create opportunities for private markets to step in and do that. We built our firm in Highland and in my career on really displacing banks within the bank loan market. In the beginning, when I started, it was all banks, and today there's a lot of investors in that space, and that will continue. But I mean, back to your point around the profitability and the business model, you got a lot of people in markets businesses that really don't want to work at a utility, right? So that adjustment is something that's going to continue to happen. And to your point around wealth, you're right, there's a great bank. There's a lot of pressure on earnings to do a lot of things there, and a lot of unintended consequences in this move for banks. So we'll see what happens. There's a lot of smart people at those banks, and they've got a lot of cheap funding, right? I mean, they've got a lot of free money running around in those places to make money with. So I think if you manage a bank well, you can make a lot of money right now. You just got to do it well.
Great to have you with us. Really appreciate your time. Thank you very much for giving it to us. Mark Okada of Highland Capital. Coming up.